or near cash. Now, and that is what you call your savings, because that is where you can pull money from immediately to meet immediate obligations. The mistake that we've created or that has been created is that savings means putting money in your savings account. No, savings means just having something in near cash that you can take out from as quick as you can. And so if I have my money in mutual funds, let's say money market mutual funds, that I know I can take that money out from there in the next 2 seconds or 5 minutes, that's also a savings account. If I put money somewhere that I know that I can take money out from in maybe 10 hours or 5 hours, maybe a treasury bills, that's a savings account. So the way to ensure is that if you understand your finances very well, you know that, for example, in a month, give or take, I would only need maybe 50,000 naira, right? It's okay to put that in your savings account, but it doesn't mean that every other money should go into any type of investment. You still want to have maybe 150 or 200 in what you call liquid cash, liquid investment. And that helps you to be able to meet any emergencies and anything that comes up. So that's it. So I'll say, instead of looking at it from a savings standpoint, always look at it from staying in cash or staying liquid with a percentage of your investments. And out of that percentage, you can put some in savings account, but put some in other investments that are quite liquid, but will give you edge against inflation. Because the truth is, with savings account today, there's no edge against inflation. You're not even making money from it. So first of all, you lose time value of money. Secondly, is you're actually not making money from it. Third is that you will even pay charges for what you run on it. So in as much as you can have just a bit of it, it helps, and then keep the remaining in other liquid assets. That's the only way to put your cash to edge against inflation in Nigeria today.
Okay, thank you so much. So now Kayode has put out a lot of information, and I'm going to break those down, as this series progressed. And that's why I said it had to be a series. I mean, we can't cover everything in a day. Now, so what Kayode basically has said is that you need to put more. When you say liquid, it means it is flowing. That means, for example, when you have ice, so see your money as ice and water. Ice is a form of water, but water is flowing. Ice is solid. So, but if I have ice, if I leave my ice on the table under room temperature, in maybe 5 minutes, it starts to flow. So that's liquid money. So if I put my money in an instrument, or what we call instruments are investments, assets or vehicles. Now, if I put my money in an investment structure, it is liquid if in the next 5 minutes, 10 minutes, or within 24 hours, I can quickly convert it back to cash that I can spend. It is not liquid if it will require maybe quite some time before I can return it back to cash. So now that now brings us to, and then Kayode mentioned some examples of liquid investment options like mutual funds, money market funds. Now, I understand that majority of persons do not even know what these things are, but they are not the focus of today. So we are going to get into them when we start looking at investment instruments and how to use them, because mutual funds still pay you better than your savings, but so many people do not know about mutual funds or MMFs, money market funds. Well, that's still a little bit advanced for what today is supposed to cover. So let's get back to the basics. So now Kayode said you need to know, maybe in this month I need 50,000 naira, and then I can put that in my savings account and then maybe an extra, which means that budgeting and planning is a very key component of your personal finance management. It means I should have an idea of how much I expect to make. So what do I do with in cases of emergency funds? Should I attend to every emergency funds, and how should I fund emergency requests? That's my question for you, Kayode. What do you think?
Okay, with emergencies, honestly, emergencies is unforeseen. You can't really do so much about it. But I look at emergencies from two sides and how I manage emergencies. First is my near liquid investments should be able to sort out emergencies. So if I have money in a mutual fund, money market fund, I have money in treasury bills, right? Or I have money in a fixed deposit, then I will use that to meet my mutual funds. Fixed deposits, I can call up. I don't lose money. I only lose interest that I have not earned, right? I can call up in maximum 24 hours. mutual funds, I can call up in maximum 3-4 hours, and then maybe a treasury bills, I can call it that too in like 4 hours. So I will put that allocation is what I use to meet emergencies, and I should be able to what do you call it, to increase that money once I've used it. Secondly, is that leverage is another way to meet emergencies. And people, when I say leverage, people run from it because they always see it from money standpoint. But one of the things that would help you build finances and wealth is to have access to what you call all types of capital. All types of capital means that you need to also have access to social capital. You need to also have access to leverage, debt that you don't need, but you just have access to it, right? You need to also have access to people and have access to money, because I can have an investment somewhere that I know that, okay, if I pull it out to meet these emergencies, I will lose some money, but I can pay it in 1 month, right? Or in 2 weeks. One of the easiest ways to be able to meet those needs is your resources. If I have access to one very free money with a bank, where I know that in 10 minutes I can request for this overdraft from a bank, or I have family and friends, or I have associates that I can know that I can pull 500, 1 million from, right? It helps you to leverage. It even helps you to do business, because you might want to invest in something that is good, but you don't have the money immediately. You need some time to liquidate. It is your access, your capital, your social capital, and all those things, your leverage, that will help you to meet those things. So there's no how you can build wealth or grow your finances without building other things tied to it: expertise, social capital, your network, your access to leverage is very important. So that's two. So first one is have liquid investments. It helps you meet emergencies. Two is have access to capital, leverage, social capital. Then third is look for risk mitigation plans. People always miss that thing. It's very easy to, in Nigeria today, you can move from rich to poor with one health issue. It could be parents, or it could be sibling, or it could be you. Just one health issue and you lose it all. There's no insurance. One accident, you don't have money again. One fire outbreak in the house, everything is gone, and they are unforeseen. The country is not safe, right? Just one kidnap and you're gone. One accident on the road and everything is gone. So it's always important to have little risk mitigation. Some things are not expensive if you know you want to build wealth. Health insurance plan for family, insurance for your house, insurance for your car. If I have an aged parent, I will put them on a plan so that I know that if an emergency comes to them, or there's a plan I'm paying for that will meet their needs, so that I do not run and inconvenience and spoil my finances, all because I'm trying to meet something urgently. Instead, I would prefer to spend that money at the start of the year to secure that insurance for them. I've had friends who have lost all the built, they made money, parents went sick, traveled to India, spent everything, borrowed from it, and then they still lost a parent. And now they're just trying to come back from where they are, right? So if they had like a health insurance, cover them, and also put preventive measures where there's steady tests on the parents and all those kind of things, it helps to do that. So let me don't delve into that. But all I'm saying is, first option is have liquid instruments. Second option is have access to resources, leverage, social capital. And the third one is ensure that you can mitigate emergencies or risk as much as you can with insurances, life plans, and co.
Thank you so much. So, in one swoop, Kayode has covered everything we wanted to cover in today's episode, right? We have seen budgeting and planning. We have seen saving. Now we have looked at insurance policies, and we're going to start taking these subjects one after the other. Now, somebody left a question. He said, "How do we meet up with investment and business plan when income leaves no excess after expenses?" And I think that's where Kayode's answers about building your personal self, your personal development, your expertise, and then taking leverage. That's debt. Now, so Kayode, what would you say is LD, the healthy way to take debt? Firstly, how do you convince someone who thinks debt is a bad thing to see it as important to their personal finance? And what would you say is the healthy way to handle debt and to take debt?
Okay, I do not see debt. Let's remove the word debt and let's focus on the word leverage, because depending on religious backgrounds, ethical relationships, some people will run away from the word debt. However, what we should focus on is leverage. Leverage is, I want to achieve something. I know this is good. Personally, this is what I can bring to the table. What can I pull to make this work? That's leverage. Now, when you see it from that angle, it makes you explore different options. Some people will not take debt, they will create either a fund or a vehicle to bring other guys to be part of it with them, right? It could be bringing other equity investors to be part of a project with them. Some people would be bring other guys to come in and say, okay, lease this place to me. I will pay you this so that I can be part of it. Some people will say, okay, you know what? I have access to finances and I can pull finances from here and there to raise money. So leverage is not a bad thing, and you can leverage in different ways. But the most common form of leverage is debt. Now, if you see debt from leverage, you can't make mistake because, for example, I can't be leveraging to buy a car. I can't be leveraging to travel to Maldives, right? That is what I will spend from my earned income or earned money. I can only leverage to create an asset that will generate money. So if you see that from leverage, you would not make mistake, right? So leverage is not a bad thing because you are using it for something that will yield money. Anything that is not going to be yielding money in return or creating income in return, you don't leverage on it, right? So if you see from that angle, you know that, say, personal debt to meet um, unnecessary expenses. I don't want to call them unnecessary, sorry, to meet expenses that are not income generating, should not be leveraged on, except when it comes to situations that are emergencies or life and death, right? But income generating assets, um, as much as possible, when you cannot meet the resources, you leverage. And leverage is not just because you don't have the money. Sometimes leverage is called risk sharing. Insurance is a leverage. I hope you know. Insurance is risk sharing. You're leveraging. Is, I'm going to put this money down because I know that all of us that have paid this money, there's a probability that only 10% of us can have these risks materialize. So we can use one to cover one. That's leverage. Insurance is leverage, right? So once you know that, you sometimes people leverage to share risk, not necessarily because they don't have the money. They use it to share risk. Some people leverage because they also want to use it to expand. Right? If I have 1 million naira today and I see a business of 5 million naira, which will give me more money than if I invested my 1 million. So why don't I put my 1 million naira and look for people that can bring in 4 million so that we can make good money and my 1 million men yields good value, as against if my 1 million went into a 1 million naira business. It's just leverage and create size. So it's not a bad thing. And for you to grow wealth, actually, if you want to really go wealth, you can't run away from leverage. You might avoid debt. You might look at other ways to leverage. You might find other avenues to bring in resources to back whatever you want to do. It could be people, it could be partnership, it could be fund, it could be leasing of assets, it could be anything. But you can't run away from leverage. You're trying to grow wealth, and it's important to start to have that at the back of your mind. How do you leverage? What are your own criteria to leverage? What are the risks carriers to leverage? And do you understand the asset that you are trying to leverage on? Once you have that at the back of your mind, you'll be good and you would most likely not make any mistake.
Okay, thank you so much, Kayode. All right, so basically what he has said is be open to taking leverage, and then debt is a type of leverage you can take. Now, leverage basically is from the word lever, which means something that multiplies your efforts. You know, that basic primary school thing where there's a primary lever where there's effort, there's load, and there's fulcrum. So fulcrum is that leverage that helps you to, lift the load with minimal effort. So really, if you are going to build a business and build a big personal financial portfolio, you have to leverage, right? So, yeah, someone says she has a question for you, but we're running out of time. The scheduled time for this webinar is 1 hour, 60 minutes. So apparently, we would work on increasing the time frame so that we can have much more time. And then we are going to ask to bring Kayode back for episode 2. There are still a lot of loose ends to tie up, but I think we have enough to, whet our appetite to let us know how much more we need to know in terms of managing our personal finances. The polls will still be open. The question lines are still open. You can always send questions to the mail. You can always reply the mail you got at registration. But today, I think today we've covered the basics of saving. We've looked at why it is important to budget and plan. We've looked at what diversifying means. Diversifying is not necessarily spreading out. There is also, going deeper. We've also looked at what it means to save. You know, and liquid assets. What is leverage? What debt? How do you leverage people?